Welcome everyone to the Kindle Report, where I share my 40 years of experience to help you manage your portfolios and protect your wealth. Remember to subscribe, like, and share these videos. As we look back on last week, it was absolutely devastating, with the NASDAQ leading the way down 4.1%, the S&P down 2.5%, the Russell down 2.5%, and the Dow Jones down at least down 1.7%. But we saw major players get whacked last week, with Microsoft and Apple and Google and all the high-end tech stocks definitely took a big beating last week. But as we come into this week, it's going to be about the Fed. And we're already seeing optimism overnight, with the futures up over 1% in expectations that the Fed will do something on a monetary basis to keep the markets moving forward. Now, I've been talking to you for the last several months that the Fed needs the fiscal stimulus as well. And we saw the Congress once again fail to get anything passed on the fiscal stimulus. And I don't think anything's going to happen before the election. So the Fed can forget about that, I believe, for right now. But the focus of the meeting this week will be a continuation of the low rates forever. Powell is likely to discuss on Wednesday's conference call the continuation of all the programs they've had in place supporting the markets, but he'll use the same old words. They're going to use all of the tools available to support the economy. But one of the things that is coming into question is the recovery momentum. I was talking about this back in August, that the expectations for September and October were going to be very mixed when it comes to economics. The Fed's aware of this. In fact, they can already see the development of many of these numbers that will be released over the next several weeks. Expect them to continue to posture that they will keep the economy strong. One of the things that's important to understand, if the Fed acts alone, the problem with this is that their actions are only going to stimulate the markets. It's not going to stimulate the economy. They already have rates at zero. They have everything supported. They need that fiscal response. And I've said this over and over in the last several months, is that it is a team. It's got to be monetary and fiscal to make this work. And with the politics like it is in this country right now, there's nothing going to happen. We'll have to wait till after the election, and who knows with the kind of things going around the election when the results will actually be in. Who knows? It might be December and beyond before we know anything. It's just the chaos is likely to be crazy as we go forward. This is ultimately going to keep the markets in somewhat of a turmoil. But as we do look at some of the fundamentals coming out this week, there are several minor reports that will be out. We have industrial production, we have retail sales, there's some other metrics, but nothing really material. As always, though, it's that Thursday claims number that everyone's looking at. Once again, expected to be about the same as it was last week, around 800,000 new. But the continuing claims uptick last week. If they continue to uptick, that could cause some concern with the markets. But also, as I've been saying, the Fed's going to do whatever they can because they want the economy to run hot. If they can get the job growth going with just a monetary input, then they will do whatever they can. I just don't think that's going to be enough. They're going to need that fiscal, because there's a lot of folks that are displaced in the economy that won't get enough money to move things forward. This is going to be a continuing problem. The other feature that I expect to happen this week is a continued volatility. Now, the weekly volatility range is now 186 handles, and the daily is dropped down to 88. But that's plenty to keep the machines involved and keeping the algorithms trading. So this is going to keep lots of daily volatility as we go forward. While all this in the backdrop is happening, our database continues to see some minor liquidation, but I do believe it's starting to bottom on a short-term basis. Let's go ahead and take a look at the charts and see what they're telling us for this week. As we review the WaveTech database, as I've been discussing over the past several days, that the sharp decline in bullish percent on the daily basis has moved us to an extreme. We're at 14.94. We're starting to see some moderate rotation at these levels, and with the markets looking like they could close higher on Monday, this database is most likely bottomed on a short-term basis. If it remains below 26% for the next couple of weeks, that would indicate there's some further weakness to come into the market. So there's still some metrics that need to unfold so that we understand exactly what we're likely to see from the database and from the markets. Also, I mentioned that I believe there'd be some minor liquidation on the intermediate models, which did occur. We saw roughly 700 sells versus 210 buys, so there was a net negative rotation on a short-term basis, pushing the bullish percent from around 70.04 down to 68.94. Now, depending on how the markets unfold this week, we could see some further negative rotation, but I do expect that the intermediate database will remain above 62%. Taking a quick glance at just looking at the sectors, we see that most of the sector positions that have been on for between 30 and 70 trading days are positive, some of them moving quite well. Consumer non-cyclical up 11%. Consumer cyclical also up 15, and then we see the services sector up 15.51%. And this is indicating some basic rotation that's going on within the sectors right now. There has been some rotation as we're seeing financial and technology roll out. Financial never really got any traction. You'll see at the bottom here it was down about 6.5% from an index standpoint. Technology has also exited. It was only long for 87 days of its normal 277 holding period. So this was a very short-term trade. The volatility that we saw in the tech sector last week neutralized this. So we're seeing somewhat of a different rotation as we go forward. As we review the daily S&P futures, once again, we've seen this higher opening trading back above the 40-day moving average. It looks like we're going to be sandwiched between the 40-day and the 10-day moving average. On ppm1, it is now a negative 0.37, which is a trend mode, suggesting that 416 to the 3406 level will be major resistance. So if this market continues to rally into the grid here, the likelihood is that we could see an R2 high, possibly as high as R3. I don't see us getting up to that next level and getting to the RXT number in this pattern. As far as support goes on this chart, we're not likely to see on a daily, since we've gapped higher. We're up currently 42 handles, up 1.2%. We're not going to see an S1, which is way down at 3,300. That's unlikely at the moment, but it is in the grid, so you want to watch out for any reversals if something were to come out and cause the strength that we're seeing overnight to dissipate. As we look at the weekly chart on the futures, this is something I discussed last week, is that one of the key levels to watch is that 10-week moving average. Right now it is at the 33.30 level. That is a big pivot. We closed at 33.40, so we rallied back in the last few minutes of the close. We did close under some of the key numbers that I talked about on Friday, but we're remaining above this 10-week moving average, and the ppms on the 10-week moving average is currently at 0.60. It's actually upticked. It was 0.56, so it's maintaining that strength, which tells us right now there's only a 30% probability to decline below 33.30 on a weekly basis. As we look at the market grid, R1 is 33.63. We've already traded above R1 weekly, and we're likely to go toward that 34.07 R2, which goes in line with the numbers I was just talking about, with the 10-day moving average declining sharply. So somewhere between 33.97 to 34.07 is likely to be the interim high this week. If we get anywhere close to the ranges that I've talked about, where we have 186 handle expectation for the S&P, if we just do half of that, we're likely to see a move potentially up to the R3 number or printing down all the way into a new low at S1 at 32.83. Fully expect to see a lot of volatility at the moment because of the momentum on the weekly charts. I expect that these support levels 33.30 will hold. I don't see the markets getting below that number at this time. Taking a look at the cash S&P on a weekly basis, we were able to hold the 10-week moving average, which is at 33.29. The close was 33.40.97. So that little rally that came in late in the session was able to prop the market up and hold this support level. And we're going to see this number move higher by about 20 handles today. So that's going to be 33.40. The way the markets are trading on the futures overnight, if we maintain this strength, that is probably going to be the lower end of the range. But this is the weekly chart we're looking at. So R1 34.56, that's likely to be taken out early in the morning. And then here we go again. R2 is 34.90. The extreme in R1 is 34.56. I don't see us getting up to that R1. We're likely to trade between the 33.30 to the 33.97 level. The next market to cover is the NASDAQ futures. We've seen a low of 11,089. S1 is 10,934, so we've not been anywhere close to that. R1, 11,161. The high, 11,261. We're getting close to R2 already as the market is up 1.84%. So markets are very strong overnight. As I mentioned in the opening comments, this is most likely just due to the Fed meeting this week. There's really nothing out to trigger this type of action other than that. We're trading right up to the 40-day moving average at 11,254. This is a key number because this will represent a similar number to the 10-week moving average, as you'll see in a minute. But we're definitely coming up to some resistance between R2. Maybe we can trade up to 11,415. That's a little optimistic. I think the markets are most likely getting a little stretched, especially on the NASDAQ at the moment. But we're definitely, from a grid standpoint, we're looking at an S1 R2 288. We basically printed the R2. We're about 20 handles from R2 right now, so we basically have already printed that. Maybe we can trade between R2, R3. It's going to be in no man's land if we trade above there. But the key number will be to close back above that 40-day moving average, which is 11,254. So we'll be watching that as we come into the close tomorrow. As we go to the weekly chart, we'll see that R1 is 11,244. So far, 11,261. So we're above R1 weekly. R2 weekly is 11,463. It's possible to reach to that level this week and trade into this grid, but the key number is going to be the high of last week, which was 11,572, which we're not likely to get above that level. Expect to see that the R2 number ends up to be the higher end of the range. If we did take out that last week's high, that would be somewhat of a reversal, set up more of a sideways pattern. But just like in the S&P, the key number is that 10-week moving average, 11,152. We closed just under it on Friday. We're back above it. Oftentimes I refer to that 10-period moving average in this type of configuration, the demand line. This is where the buyers will hang around on this 10-week moving average. So expect to see this be a pretty stable number for the week. We're likely to pivot around this grid between S1, R2 for the week. Next market we'll review is the Dow. We're continuing to see some downward pressure come here, but PPM1 on a weekly basis is at a minus 0.37. The 10-period moving average, 93.86. That will represent the high end of this market. I don't see us getting through that. And as we look at the grid range suggests that 92.40, maybe 92.14 to 93.48 is likely to be the range where we're going to trade in. We're going to continue to see this bottoming pattern, as I've been talking on a weekly basis, is that these PPMs are setting up an intermediate bottom, and this is going to continue to move within these ranges. The next market that we'll cover is gold. Looking at the weekly chart, it's very similar to the equity charts in that we're climbing this 10-week moving average. And the 10-week moving average, 0.63, very similar numbers actually from the momentum standpoint. And that number is 1948. On Friday, we managed to close at 1947. That number was 1935, so it's moving up about $13 per week. Overnight, the low has been 1945, high 1960. We look at the grid, 1930, probably 1984, and R2 print is going to be the higher end of this range. There is a key number to watch for, which was the high on 9.4, which is at the 2001 level. If it were to take that out, we could trade up toward the upper end of the grid, but right now it looks like we're going to continue in a sideways range. This is revealed better on the daily chart. It shows that there's no momentum at all on this market to move it out of this range. So we're likely to just continue to hover around the moving averages. They're all clustered between 1940 and 1963. We would need a close over 1963 to move up toward the upper end of the range. You can see here on the daily grid, 1968, then 1980 is the extreme. So that is going to be the constraints as far as this market goes. It does not look like there's going to be any real excitement in this market, at least from this configuration. The downside seems to be well defined off the weekly charts. The final market that I'll cover tonight is silver. Silver is in a similar type pattern as in gold. It has a very narrow range defined. The PPM1 is at a minus 0.57. That represents the 10-day moving average. It's currently at 27.18. The high's been 27.14, so we're bumping against that average right now. There's only a 30% probability that we'll be able to get above this level. You can see on as far as the grid goes, R2 is 27.22, and then R3 27.41. That's probably going to be the higher end of the range. And there's still a lot of downward pressure on this market on a short-term basis, which could push down into the grid on the downside between 26.68. The extreme right now I see on a short-term basis 26.50. The weekly chart suggests that the 10-week moving average is 25.67, PPM1 plus 3.14. Anything over 0.25 is an uptrend. The probabilities of declining below 25.65 are virtually nil. It's less than 10%. So if you did trade down in anywhere close into that range, in fact, probably use the grid on the weekly here to trade off of if you're looking for a position, because this is still in a strong uptrend. Even though PPMs are starting to dissipate, they got so extreme on that big surge that now they're resetting and they're going to go through a cycling, but they're going to stay well into trend mode. So there's not a lot of downside below this level here, which is the 25.65. Any number that looks like that is a bargain on silver. On the upside, it's somewhat limited as well, though. As I pointed out on the daily charts, we just look at the grid, R1 27.36, R2 is the maximum that you're likely to see at 27.93. The range is going to be somewhere between this 26.34, which would be S1, down maybe to the 25.78, which would represent a move toward that 10-week moving average. This will complete the video for tonight. Thank you for watching. We'll talk to you tomorrow night.